Hello, good morning, everyone. And thank you all for coming along this morning. My name is Craig Lowry. I'm a principal consultant at Cornwall Insight. Some of you may actually be aware of us from our work on the Ofgem default tariff cap. But we are largely a business-focused organization. We work a lot with energy suppliers and, crucially, with corporates and end users such as yourselves, and really helping them to navigate the challenges of the energy sector and increasingly the pressures associated with the transition to net zero. And what I'm here to talk to you today about is really a look at what's been happening with energy costs, the reasons for that, what the direction of travel is, what some of the key issues are as far as energy costs are concerned, and really what the outlook is for the next few years. Now, what we've seen for business energy bills over the last 3-4 years is a period of quite intense volatility in the largely almost exclusively driven by what we've seen in the wholesale market. We had a massive slump in prices in 2020 as a consequence of the COVID lockdowns and the impact that that was having on the energy market, and that pushed wholesale prices and in turn bills to their lowest level for some time. And what we've seen over the last 2 years really is a general upward trend in energy costs, that being accelerated over the last 12 months as a consequence of the Russia-Ukraine conflict. And the impact that has had on business bills, it really has depended upon when you signed your supply contracts. For instance, if you were fortunate enough to sign a contract at the trough of the market in 2020, but had to renew at the highs of 2022, you've gone really from one extreme to the other as far as your bills are concerned. And really looking at that and looking at the outlook for bills going forward, what you see at this point in time is that bills will decline from the highs seen last year and will continue to decline really into the second half of the decade. But most importantly, unfortunately, we aren't going to see a return to the level of bills that we had in the late 2010s and just before the COVID impacts took effect. One thing that just want to say about these numbers is these are an all-inclusive energy bill. Now, there has been a reprofiling of energy costs, largely due to network charges, transmission and distribution, so the costs of using the wires for electricity, which has led to more of the bill going on to the standing charge than the unit rate, which is it's something that we're going to see more of when the new charging year for network charges starts next month. So that's the sort of thing that will not only affect the level of your bills, but also effectively what you can control within your energy bill. If most of your cost is in your standing charge, then you'll find it hard to control that by mitigating your usage or better managing your energy usage. So that's really, it's something which has been pretty well documented, and particularly a challenge for smaller businesses that we've spoken to. Unfortunately, there isn't a likely reversal of that trend. It's something which the energy regulator has been keen to bring in. So that, at this point in time, is going to be an enduring change as far as the composition of energy bills is concerned, not just the level of them. In terms of the main reasons for the increase in energy bills, or the volatility really in energy bills over the last 2 or 3 years, it is almost exclusively as a result of the wholesale price and what we've seen in terms of the impact of the Russia-Ukraine conflict on bills. Now, that is something, that increase, although it became more apparent when the conflict started, it was something that really had been apparent in the wholesale market more or less from the middle of 2021, which meant that you would be seeing that increase in your bills as you went out to contract, and we had what I hope has been the peak of the market in August of last year. And really since then, what you've had is a general downward movement in prices, admittedly a very choppy and a very volatile downward movement in prices, but a downward movement nonetheless, which we would expect would be reflected in bills, although of course that depends upon when you signed your contract and how long you signed your contract for. So for instance, if you signed a 2-year deal in 2022, you would still be locked in to those prices until your agreement ended, and then you could take advantage of the lower prices. So crucially, not just the movement in the wholesale market, but also when you made your decision to contract on that particular roller coaster ride that has been the energy market over the last 2 or 3 years. As I say, you've really looked from one extreme to the other as far as prices are concerned, and in turn bills. Now, we have had government support for high energy bills, and that has effectively been through a subsidy on the wholesale element of the bill. The wholesale element is normally around 60–70% of the bill for electricity, broadly similar for gas. But what we had brought in by the government was the energy bill reduction scheme, and that was a capped subsidy, but it effectively meant that the government would pay a contribution towards the wholesale element of your energy cost. And certainly, in speaking to the businesses that we're engaged with, they have found that very, very important as far as managing their costs over the winter period has been concerned. But that support package is coming to an end from the start of next month, and it's being replaced by the less generous energy bill discount scheme. Now, the key difference between the two measures is that not only is the amount of support capped under the new arrangement, it's also a much smaller level of support, and the eligibility threshold for being able to tap into that fund, frankly, it's much tougher than for the scheme that it's replacing. As a consequence of which, the scheme has been largely criticised by businesses as a consequence of just simply not giving them what they need going forward. The budget last week didn't contain any new measures or any extension or any expansion of that of the support package. So what you will have in place for the next 12 months from April is a smaller and less generous, shall we say, support package for businesses as a whole. As a consequence of that, we are expecting that businesses will face much higher bills than in June 2021, when the latest round of increases in the wholesale market started to take effect. I'm hoping you can see the font on this, but ultimately, what you have as far as the new scheme is concerned is that you will have had to have contracted for your energy. This is an electricity example. You will have had to have contracted at a already very high price. £302 a megawatt hour, or 30.2 pence per kilowatt hour, if you're in pence per kilowatt hour, just to get the support. Now, that means that everyone who is below that level on a business contract, which is probably a large proportion, I haven't got an estimate of precisely what that would be, but a large proportion of businesses will simply not be eligible for support under the scheme. And crucially, that scheme will only cover a very small, obviously it's a relatively small, amount of the increase in wholesale costs that has been factored in to bills. So the level of support is 19.6, so roughly 20 pounds a megawatt hour, or 2 pence a kilowatt hour. So the government will only pay that band, that level of your costs on your energy bill. And crucially, anything above that level, you're liable for. So not only are you liable for that large block of energy cost or energy price exposure at the start of your contract calculation, you're also liable for anything above that level. So it's only a very small amount of bill discount that you would be eligible for, assuming that you were eligible for it in the first place. One thing which has also become more of an issue over the last 2 to 3 years is the difficulty that businesses have actually got in obtaining a supply contract. And there are a number of reasons for that. What we've seen, it really started in the wake of COVID and COVID lockdowns, is that some suppliers simply stopped offering contracts to certain businesses, certain sectors of the economy. Some withdrawing altogether from the market. Excuse me. So effectively, there's less choice out there in terms of supplier offers. And that's been the case really at the small end of the market, so the SME market, but also at the larger end of the market, the I&C. industrial and commercial market. And in both cases, you've seen different players look to exit the market. Either they're reevaluating their business propositions, they've sold their books, their customer books, or they're just progressively winding down their interest in a phased exit. So that is purely on the supply side, so the actual level of choice. At the same time, it's been harder to get a contract simply because of the level of, or the nature of the terms and conditions which suppliers are putting on businesses. Crucially, or certainly the main issue which we've seen is fears over credits and bad debt in certain sectors of the economy, of which unfortunately hospitality is one. And you're seeing suppliers, if they are willing to quote, are putting in more of a premium as a consequence of that perceived bad debt risk, or they are simply putting in tougher payment terms for their business clients. And in this situation, unfortunately, credit is king for suppliers. They do not want to be taking on what they see to be undue risk from certain sectors of the economy. And as a result of that, simply some businesses are finding it harder and harder and harder to obtain a reasonable number of quotes to simply make an offer from one supplier to the next. So in short, what that means is that there's decreasing competition for your business. There's tougher payment terms. You're seeing suppliers pulling out of the market in which they've been active for several years. And generally, there's been, frankly, a lack of transparency among the suppliers as to why that is the case and what is going on. We found that issues pertaining to poor customer service have been more of a challenge for business customers. And it's something which the energy regulator Ofgem, actually I'll just stop for a slide. The energy regulator Ofgem is looking at in its call for input, call for evidence in the nature of the market. So you can see there the key issues which they are looking at, and they perceive to be detrimental to business customers, is security deposits, credits, undue risk premia being priced into contracts, poor customer service, and just generally poor standards of service across the board from certain suppliers. Now, while Ofgem is looking at these behaviors from suppliers, unfortunately, it's not looking at the issue of affordability of bills. That is something which it says is the remit of government. So we'll have to wait and see what, if anything, comes from government policy as far as that is concerned. The regulator has been looking at the micro business side of the market for several years now, largely because there are a lot of parallels between the micro business and the domestic side of the market, and so it has a inherent focus on domestic issues, as we've seen with the price cap, for instance. But certainly for businesses at the smaller end of the market, it's paying more attention to their needs and their concerns, and particularly those who are just on the cusp of being a micro business and a SME. They almost fall out of fall off the regulator's radar. So that is something which is going to be looked at. I don't think we have a time frame for that. The call for evidence the outcome of the call for evidence, call for input will be released later this year, and we would expect any reforms to be taking effect 2024, 2025. So it's not a quick fix, unfortunately, assuming they decide to intervene in the market. A few words on net zero, largely because what we've seen as a result of the increase in wholesale prices, the increase in bills, is that more and more businesses are looking at alternatives to grid-supplied electricity, grid-supplied gas. Whether that's through on-site generation, which mean like solar panels on roofs, for instance, or indeed for larger scale businesses investing in quite large assets. But really, what you've had is that the business cases for certain measures have become much more attractive as a result of the high energy price, and crucially, that alongside a larger and wider push on energy efficiency issues is seen as being crucial to facilitate the net zero transition for the UK economy. Now, the Skidmore review, which was the review of how the government is implementing its net zero policy, it's not the review of the policy, raised a number of issues and challenges to government. Effectively, businesses are seen as being one of the key drivers of the net zero transition. But unfortunately, the net zero transition comes with costs. Cost of investment, cost of reconfiguring the energy system, and so on. And really, what the government is being challenged to do is implement policies which minimize the costs which are borne by businesses and allow them to tap into opportunities for investment. So whether it is through small-scale generation, whether it is through more innovative and collaborative arrangements with energy suppliers, whether it is through large-scale contracting, for instance, at a portfolio scale, so a number of businesses could contract collectively for their energy supply. There are a number of areas which the government has been encouraged to look at. And it's important to note that when the government introduced its support scheme for businesses at the end of last year, what was forefront, and it was clear from the policy statements, was that businesses were effectively being bought time to double down on energy efficiency measures and to almost proactively seek solutions themselves. Now, what we would normally expect is that your supplier would be able to facilitate those if you wanted to go through your supplier. There are a number of third-party advisors in the energy sector who can work with you to implement those sorts of measures. But the key challenge here is that ultimately time is not on the side of the government as far as business energy bills are concerned. We saw from the chart at the outset that bills are going to remain above historic highs for the foreseeable future, and frankly may never return to that to the kind of levels we saw in the 2010s. So it's imperative for them to try and implement a framework which supports businesses and gives them the tools, gives you the tools, to contribute to the net zero transition and not be unnecessarily or unjustifiably penalized from a cost perspective for doing so. So, to conclude, we have seen a short-term easing in prices from the record highs, but unfortunately, business energy bills will remain above historic levels for some time. There is government support for energy bills, or there is for the coming 12 months. But it's reduced and not everyone is eligible for that support. From a supplier perspective, we are seeing and expecting to continue to see suppliers pass more of the risk that they face onto their consumers, which means tougher contract terms, tougher payment terms, and at the same time, against a backdrop of fewer suppliers quoting for business. I suppose the one positive, is that this is something which is being looked at by the energy regulator. Unfortunately, as I've said, it would be 12, 18, 24 months before that comes onto the horizon. And I guess finally, just a couple of other points. Over the last few years, there's been a tremendous amount of regulatory uncertainty, regulatory change in the energy sector, and unfortunately, there is still more on the horizon. It's clear that what businesses need is some form of certainty or clarity around that, which can help them to make investments which, first and foremost, help them reduce their bills, but at the same time allows them to tap into the opportunities which the net zero transition affords them. It's clear that as far as that policy, the net zero transition, is concerned, it is going to be one which will cost the UK economy, but certainly the long run expectation is that it will ultimately lead to lower bills. And so we need to have a situation in which business support, whether it's some subsidy or another policy method, is in place to allow them to manage their own costs, their own bills, until such time as they see this new era of long-term lower costs. And as far as businesses are concerned, there are a number of options open as far as reducing bills and aiding in, or helping to support, the net zero transition. But crucially, a framework needs to be in place to allow you to tap into those. That was all I had as far as the presentation was concerned. Does anybody have any questions? Raise your hand if you do. No? Okay. Thank you all for coming and attending the talk. If you want to find out about Cornwall Insight and what we do, our website is cornwall-insight.com, and you can find me and any of the team on LinkedIn if you want to reach out and find out more about us. So thank you all very much.